start guiding you through the flow. I'll start saying the meeting will be recorded, because then we can follow up with everyone. Also, maybe if you would like to include the name of your organization, so we can also see where you come from. And let me go to my slide. So you should be able to see my screen. Voila. So let me just go here. So officially welcome to this webinar, which is Tap the Untapped number 3, and I'm explaining you why in a second, making the most of market movers. So if you were with us already throughout the month of July, you know that this is a webinar series that we have launched. We had already 2 appointments, 1st of July, 7th of July, and today we're here for the 3rd and the last one. And the idea of this webinar series was to discuss a little bit where we are in terms of impact ecosystem, the funding that is flowing into it, and we wanted to do it by sharing new insights coming from the data that we have collected in the past year in collaboration with the European Impact Investing Consortium, which is a partnership between us, Impact Europe, and different national partners based in Europe of the GSG Impact. And today, I'm here with my colleague Alessio Venturato, and I have the pleasure to welcome Rita Casimiro from Maze Impact and Gaetana Erings from FITrust. They are the 2 speakers that will stay with us today to discuss the insights. And again, if you were with us in the past sessions, you have seen we always have 2 experts coming from our community to share their perspective and to discuss a bit more of what they do in the ecosystem. And if you don't know me, I'm Alessia Giannoncelli. I'm a Knowledge and Insights Director at Impact Europe. Guiding you through the agenda now of this meeting. So at the very beginning, I will share some insights to introduce the discussion. Again, more or less, the starting point is always the same. So if you were with us in the past, you know what I'm going to share. Plus, we are going to discuss a specific data set. This webinar, it will be linked to the sources of funding when it comes to impact investors. And then Alessio will present some new insights that we came up with or analyzing all the granular data collected in the past. And we will have afterwards a panel where I will be asking some questions to Rita and Gaetan. There is time for Q&A, so if you have questions, you can write them into the chat, and then Alessio and I will make sure that we will ask them to the panelists. And there will be 5 minutes of closing remarks where I will share more links with you. So just to start, as you know, we are far from achieving the SDGs. There is a current financial gap that is being estimated by the OECD as $4 trillion per year, just looking at developing countries, which also means that if we look at the overall SDGs, only 17% of these goals is on track, whereas we can see on the slide 35%, which is 18 plus 17%, are either in stagnation or in regression. So again, a not very positive scenario when it comes to addressing social and environmental challenges worldwide. And what I would also like to share is what's happening on the public funding side and foreign aid that are also shrinking. So we see that the OECD just projected a decline in 2025 when it comes to official development assistance, which is also something we need to try to address, especially when it comes to private impact investors. We all know what's happening now on the USAID side, so with over 80% of this funding to be cancelled, but not only looking at the US, there are also other countries in Europe that they are reducing their aid allocation, meaning that there is lots to be done in order to come up to a sector that can really mobilize the resources that are currently needed. And maybe just a recap on how we estimated our impact investment market. So we were looking at the European direct market, so direct investment into unlisted assets, so the direct investment into social enterprises, for example, and we estimated that this is 190 billion, and it's growing compared to the data that we were able to collect in 2023, looking at 2022 as a fiscal year. But if we see how this is compared, when this is compared to the overall asset under management that is not allocated to impact investing, this only represents 2.5%. So again, there is an urgency of make sure that there are more and more sources and financial resources that come into the ecosystem. And the data I would like to present you today is specifically on the sources of capital. So we have analyzed, we have asked impact investors, and just in a parenthesis, when we look at this data, we only collected data on actors that were doing repayable finance. So basically all the foundations that are doing catalytic grant making are not included here. So it's a partial picture of the sector that we represent as Impact Europe, but some insights that I wanted to share that are also included in the report that you can access to, looking at the link that Alessio is going to share in the chat. We have observed that institutional investors are now the largest funding source for European impact investors, accounting for 27% of the capital, and this reflects a growing confidence in the sector's risk return and impact profile. More insights to come about institutional investors, but for the moment, this is the picture that we have included in the report. Then we also see that banks remain a major player, contributing 22% of the capital, so showing a continued engagement of these sources of capital. And we were looking at retail investors, for example, and we've seen that they dropped to 14%, and this was a percentage that was lower than the first report that we published in 2022, and we estimated that this was meant to the relative slower growth of instruments, like, for example, the 90/10 fund in France compared to other sources. We have also looked into a network individuals, foundations, and corporations, and what we have observed is that they are increasing their presence with some increase in terms of percentage point, 2 to 4. So this means that they are engaging, they're starting engaging more as a sources of capital, and something also on the public funding. What we have seen in our studies that EU funding declined by 2 percentage points, but when we looked at the absolute terms, it increased, which is also a good result, linked, of course, to the previous programming period of the Commission. And then we have seen that there were other public sources that increased by 3 percentage points, suggesting a possible reallocation via national local channels. Again, disclaimer, these are all data that comes from fiscal year 2023, so connecting this with what I just said, this shrinking in public budget, numbers might change. And maybe overall, what I would like to tell you before giving the floor to Alessio is that we see an increasingly diversified funding ecosystem, but there are definitely additional efforts to be made. For example, looking at institutional investors, they were, yes, the main source of funding, but in absolute terms, this was representing just 10.8 billion in terms of euros, which is still a small amount considering the budget that these organizations, these players have at their disposal. And also something that we see is that there is a greater role that foundations and corporations should be playing. And on one side, of course, starting to engage in impact investing directly, meaning investing in impactful organizations directly, or which is the case of the data that I just presented you, channeling their resources to support impact investors. So we, as I said, we have analyzed more data. So I would like now to give the floor to Alessio to present you a little bit what came out from the extra analysis.
Okay, thank you, Alessia. So moving to the insights of the day. So these year's insights are based on the general data shared within the European Impact Investing Consortium, and they refer to European impact investors that responded to our latest surveys in 2022-24. But first, let me show you this map where you can see all the partners that contributed to the data report launched November last year. It's tied to the size of impact. And here, I really invite you to read because this really poses the basis also for the analysis that we're going to do today. These are based on granular data. Okay, first, we wanted to have a closer look at this subset of impact investors. And again, so these are based on 134 organizations that responded across 22 and 24, representing 192 impact investment vehicles and a total of 17.5 billion euros in assets under management. And on the right, you can see the split of these assets under management across the different sources of funding. So what we can immediately see is that the top 4 funding sources are the same of the size of impact. We see banks, public funds, institutional investors, and retail investors. And together, they account for most of the capital. Instead, for corporations and foundations, they still represent a relatively small share of funding, so with 5% to 2%, but yeah, with a potential for growth. And here, I want to highlight again that as in the size of impact, public funds significantly contribute to impact investing. And yeah, if we put, as you can see here in the slide, they represent 20% of assets under management. And if we put this data in the context that Alessia just explained, I think that, yeah, now is really urgent, now more than ever, to have this discussion. And here, institutional investors, corporations, and foundations can really be the untapped opportunities to unlock more funding. So let's go to the analysis. I wanted to see how the capital is flowing in the ecosystem. Of course, one of the most important lenses to look this into is the return expectation. These are a key consideration for capital providers. Therefore, we divided our population of the subset into investors targeting lower returns, market returns, and higher returns compared to the market rate. When it comes to investors expecting lower returns, we can see that the top 3 sources are banks, public funds, and retail investors. Instead, for market returns, so those expecting similar rate of returns compared to the market rate, we can see that banks and public funds remains in the top 3, but now institutional investors take the 3rd spot. Instead, for higher returns, so for those expecting superior returns compared to the market rate, we can see 2 new actors, so high net worth individuals and private equity and venture capitalist firms. And interestingly, public funds are still there, across all the return categories. Of course, here you don't see foundations and corporations. After all, they represent a small percentage in the ecosystem. But we see that in lower returns, foundations contribute to 7%, while corporations just 2%. Then market return foundations drop to 2%, while corporations increase up to 5%, to then increase again in higher returns to reaching 80% of the total asset under management, and foundations remains at 2%. So here, trying to understand the correlation between risk profiles and sources of capital available, we can see that indeed there is a correlation. For example, lower returns on market returns have banks as a prominent source of funding, whereas higher returns, we can see high net worth individuals and private equity and venture capitals. Public funds are unique in that they are present in all return categories. And here, I think this further indicates their foundational role for the ecosystem, because they are there regardless of the return profiles. Instead, for foundation corporations, it's interesting to see how foundations are supporting lower return models, whereas corporations seem to favor more profitable impact investors. We see their contribution increasing as the return expectations rise. Another interesting lens to look at where the capital is flowing is the types of organization. Of course, the impact ecosystem has a really a wide range of actors. Also, this subset reflect this diversity. And in particular, in our subset, we want to look at the most common types of organization. And among the 124 organizations, 46% were VC impact funds, and 70% were foundations. So we will now look at these two types of organization. For the impact funds, we can see that the primary backers are institutional investors, with 46% of contribution to the asset under management. Then we see high net worth individuals and public funds. And here we want also to flip a bit the perspective, and we looked at basically among all those respondents that declared to receive capital from institutional investors. So among all these respondents, 80% of them were VC and PE impact funds. So this indicates really a strong synergy between the two actors. Instead, for foundations, we see a completely different set of sources. We see other foundations, for example, in the case of principal foundations transferring capital to investment-focused foundations, so peers. Then we see corporations, as in the case of corporate foundations, so those linked to a specific corporation. And then it doesn't surprise us to see their own endowment or trust as an important source of capital. So we see foundations that with a small diversification of sources of capital, relying mainly on peers and affiliated sources. So here you can see a recap of the insights. Overall, for us, it was interesting to see how the three sources that we identified at the beginning as untapped potential. We saw institutional investors as key sources overall for the ecosystem, but we see actually that they're mainly focused on VC and PE impact funds, and they usually target market returns seeking investors. While for corporations and foundations as capital providers, we can see that overall they represent a small share of the asset under management, but they're definitely more present for investment-focused foundations that rely on their own networks to gather sources. So this is all from my side. I think that the numbers cannot tell the full story, so I give it to you, Alessia, to introduce the panel with our speakers.
So thank you so much. And after throwing all these numbers, looking at the responses of impact investors that were surveyed, we wanted to hear it from two of them. So as I said, it's oh, sorry, I stopped sharing, but it's also okay. So it's a pleasure for me again to have Rita and Gaetan here with us. So I would like to start giving the floor to Rita with my first question. And I would like, of course, to ask Rita to briefly introduce herself and also Maze as an organization, and also maybe just focusing on the VC funds that Maze manages. If you can tell us more about your own sources of funding, and also if you can share something on your financial returns expectations. So Rita, over to you.
Sure. Thank you, Alessia, Alessio, for the invitation to be here. Hello, everyone. So I'm Rita. I'm a director and a partner at Maze. And Maze is an impact investment company based in Lisbon, Portugal, but our span of work is mainly across Europe. We do impact advisory, supporting corporates, foundations, entities in developing the strategies. We work also as intermediaries in certain financial deals of impact. Everything we do is impact related, of course. Then we also do some capacity building with growth programs like acceleration, incubation, a bit of venture building. And we do asset management by managing one VC fund at the moment, which is in the second phase, so in the divestment portfolio management phase, called MSM. And we manage another vehicle of investment. It's not a fund. It's just a very small vehicle where we've, a 1 million vehicle where we've invested in only 10 companies to test an approach of basically partnering with very early stage companies by not only investing, but also providing non-financial support going forward. In terms of our work as asset managers, we are now fundraising for 2 other funds. One, VC, traditional, like impact VC with a traditional setup, very much focused on deep tech. So really trying to take advantage of science as a promoter of change, be it in what concerns climate tech, but also in health, especially. And another fund on social housing, which is completely different. It's on a strategy and structure. Doesn't follow the VC model, but focusing maybe on the VC approach. Now, to answer Alessia your question, in terms of our investors, we have quite a wide representation of investors. I think that it is intentional, but also reactive in a way. So intentional in a way that, of course, like it widens up the top of the funnel when we are fundraising. Like it's an obvious one, but then it also brings quite a lot of added value, like having a mix of investors once you are then operationalizing your fund. So we have, on the one hand, the EIF as an institutional investor, public investor, let's say. Then we have corporate money, foundations, high net worth individuals, funds of funds, pension funds. So it's quite diverse. And to be honest, the proportions that they occupy are very aligned with the study that you've shown, more or less. And I think that, like, in terms of the pros and cons, I would say that a con perhaps is like obviously the diversity sometimes also brings more complexity, like brings different requirements from different investors, may bring as well different incentives, let's say, from the investment point of view, which can be complex on the one hand, but also can be very interesting and challenging in a positive way as well, because some investors are more perhaps financially driven, others are more impact driven, and that tension brings us a good equilibrium as impact investors. So I would say that overall, like we benefit a lot from the diversity of different profiles of investors. Also, there are advantages when deploying the capital and working with the companies, because when we're talking about corporates, for example, like having corporates actively looking to work with some of the companies in the portfolio, of course, is an advantage. And and therefore, I think we benefit a lot. And now for the new fund that we are fundraising for, the strategy is very similar in terms of, we are obviously looking at all these types of investors and trying to have a healthy mix of investors.
Thank you so much, Rita. Super clear, and also I like the fact you touch upon the beauty of diversity, but also some challenges. But I think you said about good equilibrium, so I like the quote. And then maybe going to Gaetan, can you answer the same question? So introduce yourself, your organization, and explain us a little bit more about your sources of funding. And also, something on the return expectations, and the floor is yours.
Yeah, sure. So thanks very much for having me. I hope the microphone is good. Perfect. Well, who I am, first of all, above being an impact investor, I'm a father of 3 and a happy husband. But aside from that, so I work since 25 years in the impact investment field, 12 years into the listed more part of the story, and 13 years in the unlisted. And both in Europe and in Africa mainly. When it comes to Fitrust is a French asset manager. We have 2 main activity. One is engaging with listed company as a shareholder to include more strategically the sustainable development challenge into their strategy. And the second part, where we are basically, that's why we are meeting here, is the impact investing early stage unlisted company, for which we have about 100 million in management. Within first 2 historical fund, which are at the end of their life, so within 2 or 3 years, we are going to have exited majority of our position, and that's about 30 million in management. And then 2 new fund where we have about 70 million in management, and they are at the beginning of their life. So we are looking for entrepreneur. Think about us if ever you cross their path. Those 4 funds are all playing the same thematic, which is inclusion through work or inclusion through product and services. So basically, inclusion through work is providing jobs to people that are distant from the labor market, whatever the reason in their life. And the second part is product or services that are basically answering basic needs, and that makes them accessible to everyone, being microcredit, social housing, you name it. We are a team of 10 doing that. I'm based in Brussels. Majority of the team is based in Paris. We have so return expectation and source of funding. Source of funding is quite different from what you described. So we have about 30%, which is from families and high net worth individual, direct investment. And that is really our DNA, because we want to be an entrepreneur-oriented fund. So anyone we onboard in the fund needs to be ready to be behind that wagon. And so beside that, we have about 5% from foundation. Public funding is between 40 and 50%. And then you have institutional investor or fund of fund, which represent about 20%. So why entrepreneur-oriented is really because we say actually we want to find successful entrepreneurs that have made nice exit and so on, and that says actually I want to invest in entrepreneurs that are addressing the challenge that traditional entrepreneurs are not addressing. So we are clearly saying we are not going to meet the return expectation of the market rate. So it's more about between 4 and 7, which makes it very difficult in those markets to attract capital. Basically we are saying the traditional VC funding, and that can be seen as thematic investment nearly. That is a side of the impact investing, and it's important, it needs to be there, but you can have access to different type of investor and probably a bit more easily than capital than us. And then you have foundation-like and more donation grants where that you need as well. But in between, you have basically company that need funding that are not going to be able to deliver market rate return, but that are basically still in the entrepreneurial mindset and so on. And so that's what we are targeting clearly. I hope I answered well your question.
Yes, thank you so much, Gaetan. Also, again, to stress this link between what you can expect as financial returns and the sources of funding that then you can attract. And maybe staying with you, I would like to ask you what are the sources of funding that you would like to attract more in the future, and also maybe the challenges that you're currently facing in attracting them. Again, you touched upon already a bit on the financial returns, but over to you.
So the main challenge, the foremost biggest challenge is return expectation in this inflation-oriented world, and also in the world of everyone counting a bit more their pennies. So that's the main challenge. So how to address that? First, you have in terms of the foundation, there is still a lot of them that needs to succeed to see how they can make a bridge between their mission and their endowment fund, because basically it's often very two different hats that are and two different group of people that are caring about that and how to make the bridge between that. So that's really I think one of the challenge for that group. And moreover, in a situation where a lot of those foundation needs to compensate the withdrawal of public funding for some of their missions. So you have also a tension there is how much can we consume more endowment fund to compensate the public funding. So that's from that angle. Then you have a high net worth individual where basically we need to succeed to explain to all of them, well, you have thematic and tech investment that are basically very important and that can be scalable and that can play the same, let's say, game than traditional VC, and please support them also for impact investing there. But don't forget that you have the same dedicated, fully committed entrepreneur that are actually running a business that will never be able to deliver those kind of expected return and that need funding. And that's the message we need to get clearly to them, is that there is the two, and the two need funding. And then, for the rest is basically what I find interesting in your statistics that you mentioned foundation funding foundation at one stage, Alessio. Actually, I don't see a lot of traditional private equity or VC funds saying, actually, I'm going to use part of my fund and dedicate it to an impact more oriented fund, being a thematic or a more like a sub return fund. That might be, I never really seen that a lot, at least. And then corporation, to attract them, it's quite difficult, because whether you are basically R&D for them and they basically invest and through you they are going to learn from you, and that can then be entering their space in a traditional way, or you need to be able to answer to challenge that are core to their business model and basically that are really on the surrounding their business, whether locally present or more in terms of the type of business they are in, and they are actually emitting a lot of plastic, and they want to see, I don't know, a solution for that. But that's, I think, the two only way to approach cooperation. At least we didn't succeed to find another one than those two. And then institutional investor, basically that's all about the mandate they get and how they can basically have us fitting into their mandate. To take an example, insurance company, they have very strict rules about beating their cost of capital, and even though they are a huge asset owner, how to make them able to allocate some of that and not only a very small fraction to impact investment, and not just the impact investment that can beat market return, but the rest as well, because they're legally, it's very difficult for them to act. I will stop there.
No, thank you so much, Gaetan, for the insights. And again, we touched upon financial returns in the first webinar, and now it's even clearer when it comes really to match then your own sources of funding. And on what you said on foundation, the fact that it seems there is still this tension in between the grant making side and the endowment side, because sometimes there are still two different teams. We have actually launched an initiative together with Philea as Impact Europe, where we really try to build a bridge, let's say. So it's called Beyond Grants, an holistic approach to philanthropy. So we're really trying also to talk to the leaders of the foundations to see whether there might be a change within the overall foundation structure. So we'll see whether we can make an impact there and push a bit the sector forward. And then maybe I'll go back to Rita. So you said this at the beginning. MAISE is a multifaceted organization. Then in the first question, we just focused on the VC aspect. And you also mentioned that you collaborate with corporations and foundations in your introduction. So I would like to ask you a bit more on how you collaborate with these organizations, whether it's also, again, a certain source of funding for other things that you do, and what you think is the role that they play in the ecosystem.
Thank you, Alessia. I just realized that I didn't answer super directly before the question of market expectations, or the market return expectations for the VC funds, and it's impact VCs. They follow a traditional structure. So in terms of the expectations of investors, they are the maximization of the multiple. So an IRR, let's have 20%. So, and I think it's important to mention it. And this is an approach that is necessary and it's useful for the market, especially in what concerns technology and bringing more efficiency in on the climate tech. It's I would say almost validated as a positioning in the market. And I before this session, I was in Net Zero Insights session on reporting about the climate tech numbers of Q1, and I mean it's quite I dare to say like a mainstream market now, the climate tech, especially VC climate tech impact. But it's still necessary, and it's great that we're able to attract more capital. But just like Gaetan said, and I'm making this disclaimer to now answer your question, Alessia, because Gaetan was mentioning, and I, of course, just want to reinforce his words on the fact that the impact investment market should be seen as a spectrum. We tend to focus on VC, like maximization of returns. We tend to focus on the impact startups only, which, as I said, play a very important role. But there's so much more. The big problems that we face as a society will not be tackled by VC only, right? With the expectation of really high market rate, because there are models that are necessary to be implemented that do not return these rates. And it's very important to acknowledge that. And I think that sometimes this is the elephant in the room when we talk about impact investment. Like 10 years ago, we talked about hybrid funding much more than we do now. Like now, there's a lot of interest in VC. because it's kind of like the best of both worlds, right? Together, we can have an impact and we can get a financial return, but we need to now, like that, we have reached the point of testing and validating the VC structure for one particular case and validating that it's not an answer for all the other cases. We need to talk about all the other cases. And we need to talk about other instruments. We need to talk about prioritizing impact return versus financial return for these cases, because social problems are only increasing, the housing problems. I mean, you were talking about in the beginning of this presentation about the cuts of government funding in Europe, in the US, that will have a huge impact, not to mention the budgets now that countries need to allocate to defense. That will be, you know, an enormous withdrawal of funding for social causes that were mainly taken care of by governments, and now they are being deprioritized. So all of this is important to be acknowledged, I would say. And that's kind of the work that we also try to do beyond the VC. So the VC is a mechanism, is an instrument, is a tool that we do. It's interesting to be tested. It has a positive impact in the market, we believe. It's also interesting for our own sustainability as a company, but we do not stay there because in terms of delivering our mission, we feel that we need to be broader than that. And that's where impact advisory comes in and the role of intermediaries and working with foundations, working with corporates. We try to influence in an education point of view, right? We try to work with foundations, we try to work with corporates and show them the importance of going beyond the VC angle and helping them establish proper impact strategies and showing them the potential that it has, right? Also, this basically is also an improvement from the traditional philanthropy approach that sometimes foundations have and corporates have. So there is a lot more to be explored, be it on the before VC and after philanthropy. So we try to work on them in developing strategies of investment, on what roles they can play, and we try to also then actively co-create deals with of these innovative instruments that can be tested and implemented, like social impact bonds, other mezzanine instruments, where you can combine grants with equity, where you can in one deal have a more financially driven investor and one more impact driven investor, and therefore balance the cap table. But if it's a grant, of course, the impact driven won't be in the cap table, but you know what I mean. You can balance it, and you can then give the opportunity to a more diversified range of investors to be in the same deal, which I think is also interesting. So these are the types of work that we try to do with corporates and foundations. Not to mention then, especially with corporates, we also do POCs, so open innovation, obviously trying to promote collaboration. But on what concerns the impact investment market, this is something that we are working on and that we want to be working on even more, because that's also why we are implementing now fundraising for the social housing fund, which is a fund that prioritizes impact. It's a real estate fund, but it does not prioritize financial returns. Like, it doesn't meet the financial returns of the market, but it provides some financial returns around 4%, which is interesting. It's better than nothing in a way, but it brings a lot of, at least the thesis of an impact return in this sense. So exploring these mechanisms is something that we try to do more and more, and that we feel is very necessary to be done, just like FitTrust is doing for many, many years.
Thank you so much, Rita, and also thank you for going back to the question on financial expectations. And I also would like to thank you both, because actually we believe you are two champions from the community, and the fact that you are really representing different nuances across the continuum of capital is what is really important for us. So each time that we can bring examples that are complementary in this way and still keep discussing important topic, which is the impact orientation and the mobilization of more capital, is what actually is super cool for us. So maybe I'll stay with you, Rita, because you started, of course, describing what you do as Maze to reinforce the ecosystem, and again, considering the role you play as a market builder, and of course your experience. Can you tell us more about additional conditions that you think the market should boost to really mobilize additional resources, considering what you just said also about reallocation to defense, especially in the public sector? So over to you again.
Yes, thank you. So when we look at the SDGs and funding allocated to the SDGs, if we consider the funding allocated to SDG 7, the clean energy SDG, and we consider it as 100%, so that's our baseline. If we look at the education SDG, or the life below water, or the life on land, these three are each represent 1%, more or less, of the funding that clean energy has had. Health has had around 30%. So this is just to illustrate how, like my previous point, right, on the climate tech, having a very clear business model, and the fact that I believe personally that the market has already understood that businesses need to invest in, we need to, as a society, need to invest in climate to ensure the resilience of the society, but also the resilience of businesses. And I think that there is a very clear business case to invest in climate tech for that reason. But in what concerns the social inequalities that we are facing, I am not sure we are awakened for that, because there's no business, there is not a straightforward business model. I mean, of course, you can develop a lot of edtech models that are very interesting, but for you to have an edtech that is targeting the very vulnerable populations, like they are not able to pay. So there's no ability to pay by the vulnerable, like the very vulnerable targets, right? So you can increase the effectiveness of education in like those groups that can pay for it, and of course you increase the impact you can have on those, but there's a huge group that is still being left out. And when I talk about education, I could talk about all the other topics that concern social. And so I believe that as a market, we need to understand that we need resilient societies, and that it's my personal view, it's very unlikely we're going to have a business model on that. We're going to have interesting financial rates attached to that. However, at least in the short, medium term, because in the long term, there will be concrete financial returns. I'm not sure if it's on the investments, but of course it's as a society. And the problem that we face as an investment market is that we all want to harvest the return of our individual investment. And when we talk about social impact and tackling the social inequalities in the long term, that is very difficult. So this philanthropic mindset is more important than ever. And I think that what we need as a market is really to go back to it and develop this sense of responsibility that we all have as individuals and as companies and as investors, to invest not with a financial mindset, but as a development mindset in tackling social inequalities. Without this almost unhealthy drive of getting this financial return, because I think that this mindset, which was fed over the past years, the past 10 years, 15 years, especially in the context of impact investment, was very important for us to get here, but I'm not sure it's helping us anymore, to be honest. I think now we need to explore the concept of not even giving back. It's like your responsibility. Like, we all have this responsibility. We all need to contribute to this, and we will all harvest the returns of it. So this is a little bit my message, and it's something that it's very difficult to be concrete about it. I feel that, testing new instruments, testing collaboration amongst investors, educating investors on this mindset and potential things we could do, but also educating organizations, because like NGOs, they do an amazing work, but there are so many that are not very sophisticated. They are not efficient. They are not yet technologically developed in the sense of processes, like the minimum, right? That would allow for the connection of their work with an investor that right now would not be interested at all. So it's not just a business model angle that is in the way, but it's also a little bit the capacity building of these target groups. So so these are a lot of messages. Sorry for this, but in general, I would say it's the mindset that I believe needs to be adapted a bit.
Thank you so much, Rita, and I cannot agree more. So it's, I mean, everything you said about we need to go back to the fact that it's our own responsibility as a private investors, but also as a sector at large, building a resilient society, educating investors, but also startups, NGOs, and everyone. So this capacity building component associated to the funding, the non-financial support. So everything makes sense, and I think it makes super sense to link it back to Gaetan for the last question. So I would say that recapping, of course, we need more capital to be channeled to impact investors, because then they can support social organizations that then can solve the challenges. We have seen that there are groups that can generate returns and others not. We need to recognize this. So Gaetan, building on what Rita just said, what do you think are the elements that should be announced in the market to get there? And you are unmuted, Gaetan, sorry.
I have 4 points. I will try to make them brief to let room for Q&A. But so one, I like to speak to the wealth owner, saying, okay, look, climate change has become like there is a market because the externalities are there, and basically there is a business case for client to buy those technology and so on. When it comes to social topic, there is on the product and the service side, well, it's more difficult to make a case. There can be some business case made, but it's more complex and they are less straightforward. But we need to have patient capital to test those models, and potentially some of them might become like the next biodiversity and climate change topic and investment case. And next to that, you have more the providing an inclusive society. A lot of it comes through making people part of the economy, and not just the for-profit economy. It can be the basically activity. And for that, when you speak to wealth owner, at least the entrepreneur, you said, actually, you want people to be self-sustaining. Well, we need to reduce the charge of unemployment on the public budget. Well, actually, we need to put and create company that put back those people to work and to offer everyone this opportunity. And so that speaks often, but again, it's an externality for which they won't have any financial return. But at least it speaks to the right side of the mind and not on the left side, let's say. And I think that's how we need to speak to wealth owner. next to that, we need to be able to say a lot about education and awareness that towards the entrepreneur, potential entrepreneur or existing entrepreneur that says, actually, you can think about scale. You can think about business model that might not lead to return expectations that are beating the market, but they will be investor for you, and you need to stand out because I'm looking for them and there are not that many. And also, as an entrepreneur in that field, you need to agree that you are playing in different rule. You shouldn't come to investor and say, I want to play in that game, but I want the same like crazy wealth creation for myself as an entrepreneur. That is difficult to basically combine. So everyone needs to give up something. And then to the investors saying there is a market to that. So that's more on the education awareness. Then in terms of what can generate that, well, at the moment also you have public funding is more scarce. And so the question is, how can you leverage for €1 of public spending, €10 of private capital or whatever? So you have the question of guarantee to those kind of funds saying we will never beat the cost of capital of this kind of risk that we are taking, but we can reduce the risk side maybe with public guarantee and saying indeed you are going to be slightly play on the risk side. So to allow us to take the same level of risk that we are taking now with lower return than the market rate, but with something that compensates that risk. And then in terms of also, you know, in France, there is this 90-10 where there is fiscal benefit of investing in that kind of impact investment. I think there is a way to go there that might be spread more across Europe. But again, it should be those fiscal incentives should go to the market that actually cannot beat the market return. Otherwise, you shouldn't get any special benefit. And how to get there with definition and have the sector agreeing on that, that's a long journey, but a journey that needs to happen.
Thank you so much. Thank you so much, Gaetan. And again, I think also we touched upon the last point you raised about the definition, how to define those that in the end should benefit from fiscal incentives and those not. We are trying also to work on that as Impact Europe, trying to come up with a framework that can also help, for example, the European Commission with their own regulation, the SFDR1. We're trying also to contribute to that discussion there. There's no time anymore for questions. There is a nice comment from Marco in the chat that we can look at. And then maybe just to say thank you so much, Rita and Gaetan. It was super cool to have you there. I'm going to show the last few slides going back to what we don't have the time to discuss now. We will keep discussing all these topics in Malmo at our Impact Week. So to continue the discussion, we can see each other there. We will also have a special moment to discuss defense and everything that might come with, and also, of course, innovative solutions combining different actors across the continuum of capital will be something that we'll be discussing also there, knowing how important is also to try and attract more actors and mobilize additional funding. So maybe just as in the past sessions, we will be sharing the slides and the recording. Here there's a short evaluation form because we would love to hear from you whether this conversation was useful and also if there are other topics that you would like us to bring forward. So I'll restop sharing, just saying it's once again, thank you to Alessio for putting together all the insights. And again, to Gaetan and Rita, your insights were super interesting. And thank you also for the work you are doing to move the sector forward. Thank you everyone for staying with us. You will receive a follow-up email and we'll stay in touch. Hopefully we will see each other in Malmo. Thank you. Have a nice day. Bye-bye.